Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel and Escape from the City on the ABC. And Ben Kingsley, Chair of Property Investors Council of Australia and the founder of the 2018 Property Investment Advisory Firm of the Year.
Alright folks, you're on the Property Couch where each week Ben and I bring you the insider's guide to property, finance and money management. Hello Ben.
Oh, hello Bryce.
How are you?
Good, good.
Is that excitement because Freo's second on the ladder?
Did Freo win?
They won. Not only did they win, they spanked them. Now this is the bit where a lot of our listeners go, oh no, they're going to talk about the footy again, right?
But all I'm going to play tonight. I'm not worried about that.
All I've got to say to the listeners is it's a good time to talk about footy because you got spanked. And we gave out the spankings, right? So someone, though, during the week sent me a photo.
Full stop. Did you tip your football team, Bryce?
Someone sent me
a tip North Melbourne.
Don't judge me, Ben. You have not walked in my shoes for the last 25 years following this football club, so don't judge me, all right?
That's right, I tipped you.
I did not
Richmond tonight.
Did you?
Yeah.
Okay. Oh, okay. Well, I'll feel better about that. Hey, someone sent me a photo.
Yep.
And it said, the caption was, it was an elephant
upside
down on a tree hanging over a cliff, right?
And
it said, seeing an elephant in a tree is a bit like seeing Fremantle second on the ladder. A, you don't know how it got there, and B, you know it's going to eventually fall. So I thought that was a bit nasty. But
yes.
So the footy tips, Ben.
Quick.
A quick update on the footy tips. You and I aren't doing so well.
No, we're bottom.
There's 195 people in the competition, and you and me 148 and 149. The Stig. So I didn't check. What are you? What have you come in at?
She's a Cheshire cat. She's got this.
Oh, just help me out. You've got to speak, otherwise this will take too long. How long? Where are you?
She's going to point it out. Here we go.
Oh, there we go, Stiggy. 36 out of 195. That's annoying.
Hey, mate, it is a marathon, not a sprint.
Yep, very good.
Watch us climb. We've got to climb.
But here, Ben, look at this for creativity in some of the names that people have put. Stig for Prime Minister and someone. I've put the house on it. Know nothing about AFL. What about this one? And we should pause either side of this for effect. Anyone but Collingwood. Tailored property plan for me. Tipping smarts and monkey see, monkey do. So
now, if we've just read your name out, get in contact with us. Except for the person who says anyone but Collingwood.
No.
You're going to get a free book.
No.
They're not going to get a free book.
Do you know why the exception for anyone but Collingwood? They get both books. They get both books. So folks, if you want to join our tipping competition, we have the details in the show notes. We would love to have you a part of that. Come and join us. Heaps of epic prizes. Yes. But the winner of each round, Ben, we're going to give them a book.
Here we go.
So Trent's nailed it. 7 tips. 7 tips in a round like that.
I know. You probably had all your way team. Except for North Melbourne.
Yes. And 4-point margin. So Trent, if that's you, reach out to us. You are the round winner. We're going to give you a book as well. And whoever's the round winner for the next 21 rounds, Ben, we're also going to give a book too.
Very good.
Picker.
We've got some announcements for Picker. The number one, the big thing here is in South Australia. We've launched our State Advisory Council in South Australia and we're having our first big event. It's on the 9th of April at the Gallery starting at 7 p.m. Now, for all the details and to get a ticket, go to the Picker Facebook page, Property Investors Council of Australia, Picker Facebook page, or check out the website picker.asn.au.
Will you be there?
And we'll have, yes, I will be there. I will be flying over to South Australia and I will be launching that along with our State Advisory Council people. Good council there, know their stuff. I'm excited about the work they're going to be doing for all property investors in South Australia. So get along to our first event. We'd love to see everyone there.
Very good. So the details will be in the show notes for all of what we've just talked about, folks. But the reason today is a very, very exciting day, Ben, is because we have earlier today interviewed our very special guest today who snuck us in very graciously at the very beginning of the day before they went off to a keynote to be done in the middle of the CBD. And it was, of course, Dr. Shane Oliver. Now, Ben, can I just say, I haven't seen you that giddy for a while. You were...
Alan Oster, Dr. Shane Oliver. I get giddy when I'm around economists.
So for the listeners, I spend a lot of time with this old boy here, and he's composed. He doesn't let anything flap him. He's like just... But today, I've got to tell you, we saw a little bit of giddiness, which is fair enough because he delivered in spades, Ben.
Yes, he did.
Humble, articulate, insightful, and importantly, gave a bit for everyone. There was information for people at a high level, but there's also people like me, Ben, who need Economics 101 to be pitched at a level where we can all understand. So,
well, look, you know, Shane is right up there, right? I mean, in terms of his insights and understanding and, you know, Treasury, you know, all of the powers at Canberra, listen to this guy. I mean, he's been around the woods for a long, long time. He knows his stuff. And so it was an absolute thrill to have him on.
It was a thrill, and so we're going to cut to that shortly. But Ben, my Mindset Minute theme as we lead into that interview, on my Instagram, every third day I put a mindset quote up, Ben. So
Right.
You'd know that because you're on Instagram.
Am I?
No, you're not. But this one I put up, our greatest weakness lies in giving up. The most certain way to succeed is always to try just one more time. Ben, I'll repeat that. Our greatest weakness lies in giving up. The most certain way to succeed is always trying just one more time. And that was Thomas Edison. I thought that, because I think that to myself, I'm certainly not physically blessed, I'm not intellectually blessed, but I do have the ability, Ben, to keep trying one more time. I'm a middle-class boy from a middle-class suburb of Perth, and some of the professional success I've had is purely down to the fact that I was prepared to try just one more time. And I guess in that theme, for all of our community that have been with us for the last 4 years, it's lucky I tried just one more time to get you to do the podcast with me, because I knew...
Hey, rinse and repeat on me too.
I knew that you were the biggest A-grader in town when it comes to property finance and money management. So what did I do? I tried just one more time, Ben. I said, come on, let's do this podcast. Don't say no again. Don't say no again. Eventually I got you to say yes. Didn't I, Stiggy? So, and that's been one of the best moves I've made. So we are the beneficiaries of having you on our podcast, Ben. But we asked one more time to ask if we could get Shane Oliver on, and we were successful, Ben. So let's cut to the interview now. All right, Ben, today we've got a very special guest. I know that
huge guest.
You're excited about this one.
I'm very excited.
We have an interview with Dr. Shane Oliver, who's the Head of Investment Strategy and Economics at AMP Capital Investors Limited since January of 2001, Ben. And Chief Economist since December of 1994, and was previously a research officer since 1984. Dr. Oliver is responsible for determining the firm's investment strategy and asset allocation, and also provides economic forecasts and analysis to the asset class portfolio managers. He is a regular, Ben, media commentator on major economic and investment market issues. Welcome to the Property Couch.
Pleasure to be here. Thanks for having me.
Can I just say, before we get right into the detail, I'm a huge fan, and I just, on behalf of most people who take an interest in this but may not necessarily be qualified in this area, the stuff and the content that you put out for people like me is fantastic, and we do greatly appreciate that. You know, because when you're in the industry and in the trade, you can get to go along to some of the events and the professional development days, and you do get to listen to a lot of economists. But the fact that you're so public with your information and you're out there means that people like me and all of our investment community out there who are listening on property, and they want to know what's going on and how all the cogs of the economy work, your stuff is fantastic, so thank you very much for that.
No, thanks for saying that. Often you put that stuff out there and you don't get a lot of feedback. Sometimes you do, but as you know, on Twitter, it can sometimes get a little bit narky.
Yeah, the keyboard warriors out there.
Most of the time it's pretty good, but yeah, it's good to hear positive feedback and that it's appreciated. So I think what I've tried to do is simplify things, because you can spend a lot of time talking like an economist, but only two people will understand what the hell you're talking about. So I think the key is to try and simplify it. And the thing I've noticed with Twitter is that because you've only got, used to be 140 characters, now 280, it forces you to simplify and not to waffle on and make it understandable.
Yeah, that's great. Well, so we greatly appreciate it.
Now, I want to talk about that simplification shortly, but before we do, you know, in terms of you've been involved with AMP for a long time, but take us back. What was the early stages of your career? What did that look like, and how did you get the opportunity in AMP? And now here we are standing as the chief economist. But was there a few pieces of luck along the way? Was it all well planned by you? How did you sort of arrive?
It certainly wasn't well planned. In fact, when I went for a job, I was at university in the early 80s, went for a job, I thought AMP was pretty boring. It seemed like one of these good, reliable companies that had an image icon at the time, or a brand image, which was like AMP within a TV set sort of thing. I thought this is incredibly boring. The colours were boring, and so on. But there was something that attracted me to it, and that is, the motto of AMP, Amicus Certis in re incerta, sure friend in uncertain times. Yeah. So that sort of gave me the impression that the place had a noble purpose. It was founded many, many years ago by a bunch of people who wanted to pool their resources together to help out those in need when something went wrong. So I thought that was admirable for a company, and I've found it through my time that it does try and do the right thing. So you can understand the events of the last year, the Royal Commission, have been very, almost devastating for someone like me, who was proud of the company I work for, and most of the people there do try and do the right thing. But needless to say, there's been wrongdoing, and that has to be set right, and we have to move forward. But I think, I have had a bit of luck. I think first bit of luck was that I fell in love with economics at high school. I did it at university, didn't have a clue what I wanted to do. I thought the only things economists did, they became economics teachers at school. But then an academic at university, Professor Yutner, I'll call him, said, you should do a PhD. So I did a PhD on economics, and that sort of set me up, because going to AMP, they encouraged me to study programs in flexible work aren't entirely new. That was around there back in the 80s. Yeah. And that sort of, in my mind, I thought I had a debt to AMP, so I got my PhD, and that helped me move into the role of chief economist when that role became vacant. And then I had the good fortune of the area where I was in, which researchy sort of area, very ivory tower back in those days. It was actually so ivory tower, it was on the top floor of the building, totally out of touch with anything else. So it was literally ivory tower.
Did you have a special code to get up there?
Yeah, well, yes, and you had a little thing you click on and click off and what have you. So anyway, after a little while, that area was rolled into investments, and then I got involved with asset allocation. And that sort of led to where I am today. I guess you say, well, why are you there for 35 years? Well, first one was I liked the company and what it stood for, even though at times there have been issues, as we saw last year. Secondly, they gave me great opportunities. Thirdly, every time an alternative has come up at another company, a bank or what have you, it's usually when AMP is down in a hole. And I guess I'm a bit perverse in that sense. I kind of thought, well, if we're down in a hole, next step is probably going to come back out again. So not a good time to move on. So here I am all these years later, still loving my job. I love economics. I love the application of economics to investment decisions. And I love being able to get out there and talk to people like today. Being tied to my desk 24/7 or whatever it is, 9 to 5, that would be totally boring. So it's that mix of sitting at the desk, analysing things, but also getting out there and applying it to investment decisions that I really like.
So in your own personal life and the journey you've gone on, you've bought houses or a house or whatever it is, how is it when you get to see so much data? Is the paralysis by analysis work for you as well, in terms of got to buy in this location, or this is what I've got to do, or when you're doing your own investing? There's sort of, I mean, I know in my own world there's been some opportunities and I've just overanalyzed them and moved on from them. What happens in...
Well, paralysis by analysis is a problem, and it's getting more intense because there's so much information out there, and that can bamboozle people, can confuse them. And I do worry sometimes that we spend so much time in Australia. I know we're totally obsessed with interest rates. It always seems like we're in a perpetual state of crisis. Whether that leads to a situation where people end up being perhaps too conservative with their investments and missing out on the opportunities. So that does worry me a little bit. I guess what I try to do is sort of cut it back, work out what the core issues are, get a few key indicators, focus on them, and then go from there. I do listen to podcasts, I do read a lot of stuff on the internet and so on, but there's a point where you've got to cut it off and say, well, these are my favourites. And I'll stick to them, and if some others come along, I'll have a look, but I'm not going to spend forever looking at this sort of stuff because I will get totally confused. In relation to housing, I think it's been a little bit easier because a lot of the decisions were initially motivated by wanting to live in them. And so you just find an area and then you find the house. And I was also lucky, I guess, when I got into the market, it was a good time. This is the early 90s. There's been several what I call long waves up in the Australian property market. So the 1920s, coming out of the post-war period, and of course since the mid-1990s, whereas when I got in, initially the property market was in one of the lulls that we'd gone through. I know everyone talks about after the 87 crash, there was a bit of a perk up there, but in the great scheme of things, real property prices hadn't done a lot from the high point in the mid-70s up until about the mid-80s. Then they took off as people thought, well, interest rates really are low and they're going to stay low. And then we got to where we got to.
The double household
the last
income kicked in and the buying.
Yeah, and those things kicked in, stronger population growth kicked in, lack of supply, blah, 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 blah.
Yep.
So all those things kicked in. So I was lucky. But I think I sort of worked out the area I wanted to get in. I thought at the time it was good value. I thought interest rates were more likely to go down than up. So that was another good thing back then. You could borrow a lot of money.
Yes.
Because at one point I had to borrow 350,000. I thought this was a fortune. That's a fortune, geez. And then I thought to myself, well, and the interest rate at the time was relatively high. It was around 10%. And then I thought, well, my wage has been rising relatively solidly. And in those days, yes, you had higher interest rates. But if your wage was going up, you can pay your mortgage down relatively quickly. Your debt burden goes down relatively quickly. So it is a little bit harder these days. We've got the lower rates. That's good. But you've got to borrow more. And your wages aren't going up as much. So that makes life a little bit tougher. So I think I had a bit of good luck then. It's the luck that came with baby boomers to some degree. That generation, unless they were called up to go to Vietnam, which wasn't so lucky.
Yeah, that's true.
But anyway.
Very good.
Now, as you look in the rear vision mirror of your career and what you just described there, what are some of the observations that you've seen through the cycles? You sort of hinted around the property cycles, but the cycles in general that you've seen, what are the lessons and what have you learned and what do you apply as maybe we're going into a slower period of growth in the Australian economy?
Well, the first thing is to note that there is always a cycle. Things don't go down forever, things don't go up forever. Eventually it will reverse. And one shouldn't get too scared about the cycle. I think the problem is a lot of people get sucked into the cycle at the wrong point in time. When it's going up, they're piling in, FOMO takes over.
Yes.
Same thing in share markets. And of course, when it's going down, they all get paranoid at the same time. And that accentuates the cycle. So there's a fundamental driver to it, which is often what the economy is doing, supply and demand in the case of the property market and so on. Interest rates sometimes, not always, most of the time in Australia, but not recently given the downturn. But the reality is that it's not going to go down forever. It's not going to go up forever. And I think a lot of people, the people who do the best out of the property market are the ones who say, well, when there's no one at the auctions, that's the time for me to go. When interest rates are high, that's the time for me to go. Don't show up when the auctions are crowded. Put it off for a few years, wait a bit. Now, of course, it's complicated if you're buying to live, then it's a bit different. And
you're a forced buyer.
Whereas if you're an investor, you can afford to time your decisions a bit more and wait for a better time. You'll never know it perfectly, but a rough rule of thumb. I would say today, if you're going to buy, today is a far better time to buy than 2 years ago in Sydney and Melbourne. It's just by definition. So if you don't have any confidence in your ability to forecast anything, you'd say today is a better time to buy. That's all you know.
Except the challenge that the banks, 2 years ago were quite happy to give you credit.
And now they may not. So you've got to weigh up those sorts of things. And that probably means, well, okay, you might have to wait a little bit longer. And I'd say you can afford to wait a little bit longer. But as a general point of view, when prices have gone up a lot, that's the time to sort of pull back, take your time, wait a bit longer. When top prices are coming down, that's the time to be looking around. And,
markets within markets, are you a believer in the concept that, when Melbourne and Sydney are booming, we look at Hobart and Adelaide now. Adelaide's definitely...
Well, that's right.
Yeah. So
this is the other thing. Now, it's a little bit different to when I was growing up. It seemed as if Australia was all highly correlated. One part was going up, they're all going up. One part's going down, they're all going down. These days, at least for the last 20, 30 years, and this is partly why we haven't had a recession for such a long period, some parts are going up, some parts are going down. If you take Perth, Darwin's an extreme. They've been in a hole now since 2014. Prices have gone back to where they were in 2006. And they've already had their bust. Their boom was a long time ago, it's gone bust. Adelaide's done nothing for a long, long time. So when you talk about the Australian property market, it's extremely hard to generalise. In fact, it's totally wrong to generalise. Yes, we've had a boom up until 2017 in Sydney and Melbourne, so maybe you be a bit cautious about them. But there's other parts of Australia that didn't participate in that, and that's where the opportunities are. If you look at Perth at the moment, you've got a situation where the mining investment boom has come to an end. It looks like It's bottoming out, in fact. If anything, mining investment over the next couple of years might start to pick up. So the worst is probably over in Perth. Now, I know I've been a little bit earlier in saying this, but another way of looking at it is the vacancy rate in Perth. It peaked at over 6%. Now it's below the vacancy rate, the rental property vacancy rate in Perth is below Sydney. So Sydney's is going up, which is putting downwards pressure on rents in Sydney. So that puts a flag over the Sydney property market for the time being. Melbourne's not quite as messy as Sydney is. Perth, it's coming down. So you might say to yourself, well, if I don't know anything, maybe I should look at the Perth property market. Stay away from Sydney if you're just an investor.
You look at, and our data suggesting that we have an investment committee meeting once a month on a Monday, and our data starting to show that there are some pockets of the data in the suburb level that's now starting to give us some green lights. Certainly that it's at, close to the bottom, if not near the bottom. So.
Shane, what does a day in the life of an economist look like? As you sit there and you rattle off 2014, you can go back to 2006, so there's a lot of stuff running through your head. I mean, take us through what that looks like to be across so much data. How big's the team, and what are the key metrics that you're across daily versus the stuff that you may check?
Well, the first thing I should note is that I'm very bad with names. I will leave here and won't remember your name.
Ben, Bryce.
But when I see you, again, I'll instantly recognise you by face and know what we did. So I'm not that good at names until you get to know someone for a few years. But I seem to have this photographic memory in terms of what happened in cycles and when. So whether it's 87 or the early 90s, what have you, I have a pretty good, in my mind, what's going on in cycles. So I can always put things in context. And I find that quite useful as an economist, as someone focusing on investments, because I think the key in all of this is to put it in context. Because as soon as you know that there's been something like this happen before, maybe I should go back to that period and see what happened then to give you some guidance. As they say, history doesn't repeat, but it does rhyme. No two cycles are precisely the same, but there are common elements between them. So,
it's terrific.
Mark Twain is said to have said that, but actually, when you look into it, there's no evidence that he actually said. He might have said something like that. But anyway,
everything goes to Mark Twain. Doesn't it?
A lot of it does. If you don't know where a quote came, say Mark Twain. But a typical day for me is benefit of modern technology. I get up in the morning. I used to rush into work. These days I don't need to because you have an iPad, so I look at what the share markets have done. Actually, the first thing I do is clear all my emails. There's usually 50 emails there, so I get rid of them and whittle that down to 4 or 5 key ones to have a look at. And I do this all within 10 minutes or so over breakfast. Then I look at what markets have done. Then I get in the car. I'm lucky where I live, and half of the travel is by car, the other half is by ferry, where I read newspapers, online stuff. Then I come to work. And it's usually, still wrapping some of that stuff up, what's happened today. I might do a few tweets on what's happened in markets overnight. And then I'll sort of go about my analysis. Sometimes weekly we have an allocation meeting in terms of our multi-asset funds. That's a focus once a week. I write a bit of stuff which finds its way into Twitter. I think called Oliver's Insights on a weekly. They're usually focused around issues that I'm interested in, that markets are moving in response to, that issues that are reported to investors. And then often there's data coming out, whether it's Australia or overseas, so I'll have a look at that.
And you've got a team of people who helps you put the data together into your graphs?
Yeah, it's a team of people, and they help put the graphs together.
Perfect.
What number are we talking about? How big is it?
No, it's not that big. In my little team, there's only about three or four. You could say there's a guy in New Zealand, but not quite. He does some other things as well. So it's relatively small, but I am part of a broader team which looks at asset allocation, and a broader team again which looks at multi-asset investing. So that I find works quite well.
Terrific.
Now, Ben, I know you want to drill into some of the topical things, but before we do, the last one for me on the bigger picture is how would you advise our listeners to get their head across economics 101, right? So what are some of the key things that they should be looking for? You're clearly in the data and in the detail regularly, but outside of interest rates, are there some certain things that you would recommend people make sure that they're across, so that they can actually get a whiff of change in cycles, or rather than sort of waking up one day going, oh, how did that happen?
That's a good question. I mean, one thing you could do is go to university and study economics, but that's going to be a bit time-consuming. Most people don't
online these days.
Yeah, you do a lot of things online. There's pretty good books out there. Ross Gittins is a good, in the Age and the Herald is pretty good at explaining things simply. But what I would recommend though is following a few key economists. Say on Twitter is a good place to do that, and a lot of them will give you a sort of an overview of recent data. And they'll often have charts there so you can see things in perspective. But I think one of the most important things is to try and look at charts. When you hear something has happened, bond yields have fallen or whatever it is, it's always good to put that into some sort of historical context. And I think that's incredibly important. Otherwise you can get distracted. Like on Monday I read, what should be a reputable Australian newspaper says 20 billion wiped off the share market and a horror day on the market. That was the headline. And I think to myself, gee, the share market must have fallen 5% or something. And I go and look, and it's only fallen 1%. So you should also understand that in a digital world these days, there's a lot of competition out there for your eyeballs. That competition, that desire for attention, leads to alarmist sort of stuff.
The headlines, it bleeds, it leads. So they have these alarms because it's all clickbait. They need to get that.
You need to get the clicks. The old day, you would just buy the headline on the newspaper and that would get you into the newspaper. The rest of the newspaper's headlines were fairly balanced. These days you read it electronically. Each headline has to be clickbait, otherwise you won't get in. You won't get in there, and then of course if the journalist doesn't get the clicks, he or she probably don't have a job. But I think what I would do is pick a few economists, maybe Australian, maybe global, follow them on a regular basis, say on Twitter. You can see I've got a bit of a bias here towards Twitter. Or you can go to LinkedIn. But,
well, it's good insights, right? Because I've tapped out of the news cycle for the large part, and I just then try and tap into some, and the risk of sounding like smoke blowing here, I do read your insights on a regular basis, and that helps me keep tapped in. But it's good to know that I'm on track then. That
I think that the benefit, the thing I like about Twitter is that it's, I've gone through this, it's relatively concise, and so you can get a good handle there. If the Economist, whoever it is, has a chart there, then all the better. You may not want to go off the links because that takes longer, but I think if you follow a handful of economists, there's a few good websites out there. I mean, obviously you guys.
We appreciate that, but your handle on Twitter is at Shane Oliver?
At Shane Oliver AMP.
Okay.
Someone said I should lose the, last year they said to me, maybe I should lose the AMP bit.
Was that a hint?
Well, I don't know when the Royal Commission was going on. Then I thought to myself, well, AMP has done some wrong things here as discussed at the Royal Commission, but the bulk of the people at AMP try and do the right thing, so I decided, I'll keep that there. And it
one in all in.
Also reflects my view that they do still have a noble purpose.
All right, well, now we're getting into the economics of the world, so I'm rubbing my hands for those people. So I want to start overseas. Now, the big news that we have seen over the last few days has been the yield curve, the inversion of the 10-year and the 2-year, and the prediction of a recession based on that, a global recession based on that, has been reasonably reliable over the years, and so a lot of the bear market were throwing their weight around that. So can you just explain to the layperson what we're talking about here and why is it significant, or is it as not significant this time around?
Well, that's a good question. Yes, there's an obsession with the yield curve inversion, and you sort of wonder, well, where does this one come from? What the hell is a yield curve and what the hell is an inversion? Basically, you've got all these bonds or interest rate bonds that have been issued by governments, and the yield curve is a measure of the gap between, say, a long-term bond yield, say a 10-year bond yield, and a shorter-term interest rate, whether it be a 2-year bond yield or an overnight interest rate as set by a central bank like the Reserve Bank or the Fed. So what's happened in the last week or so? It's been happening for a little while now. Starting last year, there was worries about global growth that reflected in share markets falling. But around the same time, particularly from November, bond yields have fallen around the world as investors have said, well, we were thinking that maybe central banks were heading in the direction of tightening, led by the Fed. Maybe not. Maybe they're not going to be tightening. Maybe they might even be easing. And we've obviously seen that in Australia. They were talking about tightening, now they're talking about being on hold. I reckon they're going to ease. And the same has happened globally. So consequently, long-term bond rates are really just a reflection of the market's expectations of interest rates over the long term. Given that those expectations are now coming down, you've seen long-term bond yields come down. 10-year bond yields have fallen all around the world. In fact, in Japan and Germany, they've gone negative. And that, of course, has also pulled the bond yield down in the US to the point that the 10-year bond yield is now below around 2.4%, falling below the levels of the official interest rate in the US. And historically, that has preceded US recessions. So that's what they refer to a negative yield curve or an inversion, where long-term interest rates are below short-term interest rates. And that's preceded recessions. It's certainly preceded the last 3 recessions in the US. And that's what's got investors negative or concerned about being spooked. You see a bit of volatility in share markets, a lot of talk about maybe the world's going back into recession. Now, of course, you've got to put this into some context. There are some qualifications around this. It's not a perfect indicator. Yes, it has preceded recessions, but the average gap between the yield curve going negative and recession starting in the US has been about 15 months. Share market only looks forward about 3 to 6 months, so maybe it's too far away for the share markets to worry about. In fact, after the last 3 inversions in the US share market actually rallied more than 20%. So this just throws a lot of confusion in there. Secondly, it can give false signals. Mid-80s, mid-90s, it inverted. Everyone said, oh, gee, recession's on the way. And then a few months later, it's back to being positive again. Thirdly, there's a bunch of things that could be pushing bond yields down that are unrelated to expectations of recession. Notably, the fact that there's still this quantitative easing going on, money printing, central banks buying bonds, particularly in Japan. Looks like it might start up again in Europe, and that's pushed Japanese and German bond yields negative, and that drags down bond yields in Australia and the US. But that may be unrelated to expectations of a recession. So the yield curve inversion may be due to technical factors. It may not be giving a good signal here. So you've got to treat it with a bit of caution. Finally, when you look at the US economy, I still struggle to find the other signs that it's going into recession. Interest rates are still not high. Bond yields are now falling. Guess what that usually means in the US? Because Americans always borrow long. They have these fixed long-term 30-year loans. 30-year loans. So it's going to mean lower interest rates in America. Their housing market's probably going to pick up again. You haven't had a housing building boom, you haven't had a tech boom, you haven't had an inflation problem, interest rates haven't gone up that much, wages growth still benign. So a lot of the things that normally precede recession simply aren't there. So I think a lot of this concern is just hype. I think it's a bit like the fears we had around the Eurozone crisis. Remember 2011, share markets at the time fell 20-odd%. We all thought the sky was falling, turned out to be okay. Likewise 2015-16, we had a similar thing, turned out to be okay. I think it's a bit like that.
And there's always a balancing act in this as well, because what that does mean, if I'm understanding it correctly, is the cost of money, of interbank lending money and all that also comes down, which should mean that the margins and the cost of money that the Australian banks are, and also the second tier lenders and all that, in terms of where they source their money in international markets, that comes off, which means that the margin squeeze that we've been seeing with the banks and their justification for raising our retail rates, what mum and dad mortgages paying, that pressure's now easing. So we would hope that if there is a correction in interest rates, that the banks would pass that on in full.
That's right.
There's probably not an argument for them not to pass it on in full.
That's right. That's very right. You think back to, was it August, September last year? The banks raised rates by 10 to 15 basis points. That was because our short-term interest rates were rising relative to expectations for the Reserve Bank's interest rate.
And the tightening cycle that we saw coming, both in the US and in Australia.
About tightening in America and so on. Now, of course, that's all reversing. The bank bill rates have come back down again. So if a bank is borrowing money out there in the wholesale money markets, the cost of that money is coming down. So they may be in a position at some point to cut rates, reverse that 10 to 15 point hike, or alternatively, probably a bit of both, the Reserve Bank at some point cuts interest rates and the banks would pass that on in full. So that's arguably a good thing.
And we're watching banks, we're watching Big Four. So,
right.
there was some, I'm in your camp. I definitely think that there's going to be an easing in regards to the cash rate. So I think, yes, we would like to think that if there is 25 basis points, whether it be between sort of May and October, that the banks would pass that on in full. And that would have an immediate effect in regards to consumer confidence and potentially bottoming out the property market earlier than what some people also predict.
There's a lot of people talking about 40% crashes in the property market. I mean, this may happen. It has happened in other countries. but I'm not that negative. I think there's more downside in Sydney and Melbourne to come. You know, Sydney, you could argue, a little bit worrying, given the supply hitting.
Yep.
So probably a bit more downside there. In fact, I think top to bottom, they'll probably come down 25%.
Yep.
But just bear in mind, Sydney went up 75%.
Yeah,
25% takes you back to where you were.
Well, it only hurts the people who got in late, doesn't it? The people who've been in for a while.
I know, it's painful. And that's an argument why the Reserve Bank would have to cut interest rates, because there's a bunch of people who got in around 2016, 2017.
Yeah.
They got big mortgages, and suddenly they hear all this noise about their property going down. They might have negative equity. One way to help them is to lower their interest bill.
Yep.
And that helps keep consumer spending going in the economy.
Yep.
But
it doesn't fix the supply side straight away,
it doesn't fix the supply side. But you've got this funny thing going on here. We're talking about oversupply potentially in Sydney.
Certainly in units.
Certainly in units in Sydney. Potentially in Melbourne, in certain parts of Melbourne. You know, the crane's going to be more concentrated in Melbourne as opposed to in Sydney and all around the CBD.
Yep.
So now that's going to lead to a situation, because if you're looking there, the cranes are actually coming down.
Yeah.
You know, the new supply story is starting to come into the market. A couple of years' time, maybe a year's time, it will start to go the other way. There'll be less supply heading into the market. If we're not careful, we'll end up with another undersupply. Here we go, the cycle repeats again. So,
because isn't that the biggest strength of our economy, is the fact that we are continually getting more people landing here?
Well, yeah, the population growth, 1.6%. I know the government said they're going to cut back their immigration target, but that's only going to cut it back to reality anyway.
Yeah.
So you're getting 1.6% population growth in Australia. That's about almost 400,000 people every year. A big chunk of that is almost 2/3 of that is immigration. So they're not just young babies, they're people in their homes. So that's an issue. In Victoria, it's 2.3%.
Yeah.
Victoria is the strongest.
Melbourne,
so a lot of people coming in. So that provides a bit of support to the property market. And when you then start to see building approvals come off, the cranes start to come down, that tells you that supply will start to slow out there. And then if the Reserve Bank is cutting interest rates and that is passed on to consumers, to people with a mortgage, then that will help the property market bottom out. The other thing that might happen is if we have a change of government, I reckon it's odds on we'll probably see another first home owners grant. Like, I don't like first home owners grant when we've got a boom on, because it just puts prices up even higher. But when you don't have a boom on, they do make some sense. We used them at the time of the GFC, we used them at the time of the, I think, early 80s recession and the early 90s recession, and they worked a treat. So that, I think, will also help bottom the property market out. So yeah, more downside from here, but I don't think the crash scenarios that are going to cause a whole crash in the economy, I think that's overblown.
You mentioned the possible change in the government. Have you factored any of that in terms of what your projection for the economy if the government was to stay unchanged versus if the government was to be changed going forward this year?
Well, either way, I think we're going to see fiscal stimulus in the next financial year. So obviously the budget in Australia will do that, but then you've got to see who wins the election to see what ultimately comes through. But I think it's going to be some combination of tax cuts. There's a bit of that already coming through, but bigger tax cuts than the ones that we talked about a year ago. And the government seems to have the flexibility to do that. They put some money aside in their December budget review, $3 billion there per annum basis. They're probably running at least $3 to $5 billion better than expected in the budget numbers, so we're on track for surplus. So that gives them a bit of flexibility to do a stimulus there. If there's a change of government, the focus on that stimulus will shift away a little bit from just tax cuts to a bit more in terms of government spending and maybe a first home owners grant. So that's something we'd have to see who wins the election. But I think whichever way you're going to go, you're going to get some sort of stimulus pumped in, which will also help the economy. And if anyone hasn't looked at it, the iron ore price still over $80, partly helped by the disaster Vale had in Brazil. But whatever, the price assumed in the budget is $55 a tonne. Each $10 increase in the iron ore price above the government's expectations adds $3.6 billion to Canberra.
Wow.
Every year. It's incredible,
on an annual
isn't it?
basis. So as long as it's up there, there's quite a bit of money rolling into Canberra, which will help them out a little bit. So we'll get stimulus. In terms of other impacts, I think a Labor government will probably be more interventionist. Obviously, a lot of changes in terms of tax that will worry people. Obviously, the changes potentially in terms of the property market, negative gearing and capital gains tax, which would probably be a negative for property and may add to the downside a little bit. But by the same token, Labor historically has taken advice on these things.
Let's hope so.
Yeah, let's hope so. Look at Hawke and Keating come in 1983, and what they ended up with after they spoke to Treasury was very different to what they were thinking before they took office. So hopefully they'll take advice. The other, I guess, the reason you don't want to get too negative about a change in government, because no one likes the uncertainty, is that if things do go off the rails, Labor has been a little bit quicker in the past in providing stimulus to the economy. You can criticise the checks in the mail and the school hall program and so on, but it was one factor which helped us avoid recession at the time. So,
Definitely.
I'm not going to get totally negative if Labor wins. I think we'll survive as we have in the past.
I did notice that the economy mid last year was running at around 4% annualised for the first half of the year, and then fell off a cliff. And from my point of view, where I sort of saw the evidence for me was business confidence just collapsed in that sort of, and I can only relate that to the Malcolm Turnbull sort of dumping and business, because where else does that come from? Like, if you're running so strong and running so hard, and then you've got uncertainty in terms of the political sphere, that correlates to business investment, business confidence.
It's interesting when you look at business and consumer confidence, they both perked up in 2013, around the time of the election then. And that, I think, was because investors and consumers in Australia thought, well, oh great, that period of minority government, the uncertainty of Rudd-Gillard-Rudd, that's over. We're going to have a bit of certainty. Now, consumer confidence then over the years went back to around neutral, around average, because of very low wages growth. But business confidence held up, and you're right, it did fall off a cliff around August last year, and I think that was distressing in a way, because business was suddenly then reminded, we may have a change of government that's going to cause uncertainty. The Liberals can't seem to manage things that well. I'm from New South Wales. The Liberals up there seem to manage things pretty well.
Yeah, the economy's booming. Third term.
Particularly, and seems to be a model of stability, how to do things.
Full employment.
Now, hopefully, Libs down in Canberra will get the same message at some point in time. But I think that was certainly a factor, and that provided a reminder to business that there may be a change, and that led to all that uncertainty. Ever since then, we've been talking about the approaching election.
Yeah, and I think that's what's going to happen. We're going to be in a holding pattern until we get out the other side of this. Yeah. I don't think you'll see businesses like us who, we employ 50 odd people, but we're not in the position to go again until we know what's going to happen with the property space, because that's what we do. And a stable even a stable property market is better than a market that's uncertain. Because that changes mindset in terms of how we're doing it. So we can't make those investments either. We're only a small...
It does make it hard. I mean, the uncertainty around negative gearing capital gains tax, you can argue about the merits of these. I would say that the capital gains tax discount is too generous. But on negative gearing, I personally think it's a fundamental principle of our tax system that if you invest, you're able to deduct the costs of that investment. And I don't think tax system is the cause of why we had high property prices in Australia. I think the cause was we have a lot of people coming in, we didn't supply enough property, it's been too tough for developers. Lately they've been able to get up there and put up mainly apartments, but I think that's the real issue, that we haven't been able to respond to demand properly. But nevertheless, I can sort of make a case to change the capital gains tax discount, but I think doing them all together at a time when the property market is down, as opposed to in 2016 when the property market was up, does risk a little bit around the property market, making it worse than it needs to be. See, you want affordable property, but you don't want a property
at the expense of everyone else.
Yeah, everyone else. You've got to have some balance here, and
to get 15% of the market in, you don't want to collapse the whole thing.
Yeah, you don't want to collapse the whole thing, and you don't want a situation where that 15% who want to get in don't even have a job and can't get in anyway. I always say to people, who want more affordable property, be careful what you wish for. The last thing you want is a 30%, 40%, 50% collapse, because odds are
it doesn't just affect the investor. The owner-occupiers caught in this, who have no interest in investing in property. They just want to own a home, and if they're paying interest on it, they'd like it to appreciate. Because if they worked out how much interest they're going to pay over the course of 15, 20 years that they're paying it, they want the value to be higher than what they've paid. So there is an argument there, and I think I'm with you. There's a conversation to be had around taxation and property, and it's a bigger conversation. I just don't like the policy that they put forward, where they create a two-tier market. new and existing, and a
But
secondary
that's going to be a
market.
huge distortion in the
Yeah,
market.
it is.
There must be a better way of doing that. I think you can maybe make an argument where someone's got 30 investment properties.
That's ridiculous.
Yeah,
That's
agreed.
ridiculous.
Yeah,
Put a
yeah.
cap on that somehow. But
Absolutely.
I'm always worried about intervening in markets where you do something which sounds good, but it actually creates another distortion, and you end up with unintended consequences. So that does worry me a little bit. It also worries me a little bit that what's proposed is quite a lot of tax changes. Increasing the top marginal tax rate on higher income earners, increasing the Medicare levy for the same people, capital gains tax discount changing, negative gearing, 30% tax on trust distributions. Put all those things together, it will actually increase the effective tax rate for higher income earners quite a lot. And if you look at the tax system in Australia, you've got something like the top 10% paying 50% of the revenue going to Canberra.
Yeah.
And I agree that if you help the lower income earners, they will spend more of any tax break they get than higher income earners will. But by the same token, you do want to keep decent incentive in Australia. Otherwise, I can imagine a situation, I probably won't do it, but I can imagine my kids saying, well, in Singapore, I'll pay, 20 cents in the dollar. I go to Hong Kong, 15 cents in the dollar. I'll go there, save up some money for a few years. And I don't really want that to happen. New Zealand, 33 cents in the dollar.
Yeah. So most of us, I think most Australians would say we believe in having a go and a fair go, but you've got to have a go. If it's a fair go for everyone, but if we disincentivise people for having a go, what do we get? We don't get that entrepreneur who says, I'll start in Australia, I'll start in Singapore, and what have you. And the Alassians of this world and the next generations of companies, we want them to start here and hopefully stay here. But if we don't get that, we won't get that transition to the digital age, and we won't have those jobs. And that's challenging.
I think we've got to manage that. We've always had a problem with tall poppy syndrome.
Yeah, we do.
We don't want to accentuate that.
Yeah, agreed.
So Ben, we've been very lucky to get Shane to join us today because he's got a keynote in the city that he's got to run off to. We've got 5 minutes. We've got one more for you, mate.
Oh, well, I think we've done the house prices, we've done negative gearing. The rate cut, so what's your tip for the interest rates?
We're looking for 2 cuts, and that's been our view since December now. We were thinking August, November, because if you look at what the RBA does in recent years, they only move mid-month of each, because that's when they put out their forecast reviews and so on. But it could come as early as June or July. So I think at the moment the Reserve probably thinking, let's see what's in the election, what's in the budget and so on. But then I think by mid-year they'll be moving. Interestingly, the Reserve Bank in New Zealand, they were neutral. They said it looks like the next move will be down. They signalled that, and I think that's probably a sign in which the Reserve Bank will go. So 2 cuts this year. If they leave it too long, could be more. But I'm certainly not in the camp that says, oh, we're all ruined. They're going to have to cut rates to zero and we're going to have quantitative easing.
No.
I do think there are parts of the Aussie economy that will keep us growing, just as there were after the mining investment went bust. Investment boom went bust.
And what role can APRA play in this? I have a certain strong view on this, but what role can APRA play in terms of helping the Australian economy? Because they did a great job in taking out the systemic risk in the property market when we saw 55% of all new lending in New South Wales to investors. They put the handbrake on with the assessment rate. But is there anything that they could do? I know they've got a bigger cause in terms of the stability of the financial system.
I think they've done it's always hard for regulators like that, but I think they've done a good job in taking the heat out of the market, and they've now moved to a situation where hopefully we won't see a repeat of the situation where all that money was going to interest-only borrowers. And so you've got more fundamental lending standards in place around checking people's income, expenses, and making sure that borrowers don't have too much total debt relative to income. And there's another bit to go that with comprehensive credit reporting, which kicks in the middle of this year. So one thing I do worry about is that the interest rate test they put in place is relatively high at 7.25%.
I think it's now down roughly to 7, but if we see 2 rate cuts, they've got to move that.
Yeah, that would have to come down.
We are not going to see interest rates at 6.5%, 7% retail in probably the next decade or 2. And if we were there, we're going to have zero full employment. We're going to have a booming economy. We're going to have inflation running at 4 or 5%. It just doesn't look like that's going to happen in
I think that the maths is such that with much higher debt levels these days, you won't need, when the economy eventually takes off, you won't need the interest rate hikes that we had in the past.
Agreed.
So to get, what's average mortgage borrower these days? We'd be paying 4.5% or something to get up
3.5, 4
to 7.25. I think is a big ask. You might at a stretch at some point get up there to 6.25, something like that. that's a long, long way away. So,
and if they're assessing at that level, it's like just 50 basis points movement in that can relate to $50,000, $100,000, $200,000 in additional borrowing power.
Yeah.
Now, it's that type of measure where the market's sort of capped out and now the property prices are coming back down. That'll put a floor. Yeah. We're not saying let's go back to crazy times where, you know, some lenders were lending based on other financial institutions' actual rate. They didn't even put a loading on it at all, and that meant that people could borrow more and you could get the 6th and 7th and 8th and 9th property. You can't do that as an investor now.
Yeah.
That's all
I think there's
up.
enough checks and balances in place, and once comprehensive credit reporting, which is where a bank will see whether you've lied to them about the number of loans you've got. Once that's in place, then I think those things will do the trick for you. I think that's probably something that APRA will probably have to look at some point, just lowering that to a more reasonable. The test used to be just make sure they can withstand 200 2%.
Yeah, that's right. Yeah.
And that seems a reasonable test to me, but 7.25%, 7% seems sort of based on ancient history rather than current realities.
Agreed.
Yeah.
Well, it's been a joy and privilege to have you join us on the Property Couch. I know Ben was very excited. I was really pleased to have you on too. Thanks for sharing your insights, not only at the level of understanding that you have over 30 plus years, but to break it down to a level where most people can understand, which I think is really terrific. And we certainly appreciate that you've squeezed us in prior to heading off to the CBD to do your keynote. But Dr. Shane Oliver, thanks for coming onto the Property Couch.
It's been my pleasure, and thanks for having me along.
Thank you.
How good was that, Ben?
That is terrific. It's it's timely. I mean, the guy obviously knows his stuff, Bryson. So it was a real thrill to get to meet him. Very humble, you know, relaxed, and very insightful. Insights.
He and just for folks, just to let you know, we literally were squeezed into his diary. Yeah. We got in early so that we could get it. We had a split time. We were on time. We made sure we prepped in advance.
He came to us. I mean, what a gentleman! What an absolute gentleman!
So hopefully you got something out of that, folks. Why don't you let us know on our socials if you got some feedback from that, because we think that was really good. Hey, my hack today, Ben, is a money hack. It continues the theme around tips for running your credit card account. A couple of things. If you stick to our Money Smart system, you will never pay interest again on a credit card.
Correct.
I repeat, if you use our Money Smart system the way it's designed, you will never pay interest on a credit card again. So folks, for those of you that are paying a fair bit of interest on your credit card, you really need to understand the system, because it's therefore irrelevant what the quoted interest rate is on the card, because what's more important is you look for something that is up to 55 days interest free, doesn't charge any annual fees, has the ability to auto sweep from your primary account. Those people who understand the system know what we're talking about then, the potential to offer loyalty or rewards points. So as part of my hack today, Ben, I was going to do a very quick case study to help people understand what the up to 55 days interest free actually means.
Terrific.
People often will go, oh, what does that mean? Okay. Let's assume the 1st of June is the
writing it down. 1st of June
is the first day of the statement, and the 30th of June, Ben, is the last day of statement. What it means is it'll be due 25 days later, which will be the 25th of July. So 1st of June is the first day of your statement. 30th of June is the last day of the statement. That's your billing cycle, and that billing cycle payment will be due on the 25th of the next month.
Which is 55 days, Bryce.
55 days. Now, here's the case study. If you were to make a purchase, Ben, on the 1st of June for $200...
Yes, got it.
That would give you 55 days interest-free on that particular purchase.
Correct.
But if you then made a subsequent purchase for $100 on the 20th of June, Ben, you would not get 55 days interest-free on that.
No.
In fact, you would get 35 days interest-free.
Correct.
And if you were to make a $150 purchase on the 30th of June, which is the last day of the billing cycle, you would get 25 days interest-free on that amount. So therefore, when your statement is issued for June, you will owe how much? 200 plus 100 plus 150, which is $450.
Correct.
So as long as you pay $450 on the 25th of July, Ben, you will not pay interest on an up to 55 days interest-free credit card.
And where's that $450 sitting, Bryce?
It is sitting firmly, squarely, parked with the handbrake on in the offset account, making sure it is reducing the amount of interest that you will be paying on your most expensive debt.
Correct, and if you don't have an offset account, it's also in your high interest account. So your primary account based on our Money Smart system, mate.
So Ben, so with that $450,
yes,
the key for that is to make sure that it's auto swept.
Yes.
It's got to be auto swept.
So you don't forget.
So you don't forget, Ben. You can't go, oh, day after now I've got to pay interest. If it's auto swept. So you've got to go to the bank and say, can you make sure that in that example, the $450 it's not down to memory, Ben.
Yep.
It's not down to you've put it in your intro and you'll get to that later. It's not down to putting it in your calendar. It's down to get on with life because it's sorted.
Bryce, and just to add to that, you don't have to go into the branch network. Some lenders pick up the phone, some even organise it based on the apps or the internet banking. So my advice to you though is pick up the phone for your particular lender and ask them about auto sweeping the credit card so you never pay interest again, but you get the benefits of other people's money sitting in your offset account, sitting in your high interest account, and bang!
And what will happen, Ben, if you do that? You will make money simple again. What were you going to say?
Make more money.
Yeah, make money simple again. Make more money simple again.
I love that. It was great.
You like that?
And I'll tell you what, in our community, which almost now is racing up to 1,000 people in our group,
yeah,
we're getting
Is that an exclusive group, Ben?
No, everyone can join, Bryce. Everyone can join. So, and I've got a little surprise at the end of the show, so hang around. Hang around.
Okay, I'm hanging around, bro, but did you know?
Did you know? Did you know? So, Bryce, we had some big data come out at the end of last week around from SQM Research.
Ooh.
Okay, and it was on the impact of negative gearing. Okay, and what's going to happen to both rents and or property prices. Now, they did a couple of models. Okay, so and we're going to put a link to this in the show notes because it's really important because it breaks it down by suburb. But I'm conscious of time by suburb, by city.
Yep.
So I'm just going to do the national number today. But please go and check it out because it's going to be really important. But here's what they're talking about based on a couple of scenarios, and I think this is the best way to look at it. So the first scenario is 2020 to 2022, and this is what we're going to be looking at in terms of the modelling that they did. So they did the cash rate of 50 basis points in late 2019, early 2020. Rental yields will rise between 50 to 95 basis points. Labor policy will be May 2019, so Labor government from May 2019, negative gearing kicking in from 1 July 2020, okay, and that's what we're going to see happening, right, in terms of, now, this is what they're saying. So rents are going to rise between 7 and 12% based on that scenario. Scenario number 2 was no change to the cash rate, but everything else remaining the same. Rents are going to rise 8 to 15% across the country. And then the last one, if 50 basis points cut in interest rates, negative gearing stays, so no change, listening Labor, no change, rents are only going to rise between 3 and 9%. Okay, so there's definitely a material change to rents. In terms of dwelling price forecast, Bryce.
Here we go.
So let's use the same scenarios again, 2020 to 2022. Scenario 1, we were talking about a 50 basis points cut on the cash rate, rental yields between 60 and 95 basis points, Labor government in May this year, negative gearing changes 1 July 2020, and the capital gains tax increases as well. So that's meaning the reduction of the 50% exemption down to 25%. Property prices based on that model are nationally going to fall a further 4 to 8%. Ouch. If there's no change to the cash rate, property prices are going to fall between -5 to -12%. In some markets, just to give you some idea, we're talking about Sydney tipped to fall up to 14%, Melbourne tipped to fall up to 16%. Okay, now, no change to negative gearing or capital gains exemptions, 50 basis points rate cut, move from negative property prices for everyone to +8 to +14. Ooh. That's, so in a case that's 20 plus percent turnaround, 20 to 30% turnaround in some markets. So
highly credible research. SQM headed up by Louis Christopher.
It is.
So that's not
been in the game for a long time. Knows his data. So there you go. So that was my did you know, and that message needs to get out there because it's not just property investors who are going to be affected. It's mum and dad owners as well who own property. So it's really important.
Isn't it interesting, the research that we were talking about the other day too, about the people, how many people are totally unaware
Yes.
of the changes that are about to come through negative gearing. So it's good that you're putting the message out there, Ben. So very good. I did know that, I've got to be honest, but I think for the benefit of the listeners, it was a very, very good did you know. But Ben, on a big day today,
Yes.
I throw to you, Ben.
Okay. There is going to be a mini podcast, Bryce.
Ooh.
A mini podcast that's going to come out in a matter of days
Big
over the
announcement.
weekend.
Okay.
And we are going to be launching
Uh-oh.
insights into what we call Money Fit, Bryce.
Ooh.
Money Fit.
Yeah, I want to be
so
money
we have
fit.
our Money
You want to be money
Smarts
fit?
money management system, but we want to be Money Fit. Now, how do you get Money Fit, Bryce? Well, you'll just have to tune in to the podcast that's going to be released very shortly.
You're going to deliver
Just a
the
little
gym,
mini
the
podcast,
gym for money.
a gym for money, and launch what we're doing in the Money Smarts
like it.
platform. So
You
over the
heard-
weekend, you heard it here. If you haven't already listened to this podcast, check out Money Fit. There's this little mini podcast on Money Fit.
Dr. Shane Oliver's already rubbing off on you, Ben, because he says it's not about information anymore, it's about insights. So you're about to give some insight. Oh, I like it. So, all right, well, stick around for that, folks. You keep your eye on the podcast app, the Spotify app. Ivis helped me out on the Android app. Wherever you get your podcast, Ben, because something's coming.
And Facebook as
And
well.
you just put a panic on Ivis's face because she's thinking, oh, you didn't announce that before the show started. So very good, mate. Until next week.
Knowledge is empowering, Bryce, but only if you act on it.
Very well said. See you next week, folks. Folks, we hope you enjoyed this episode. Just a quick reminder that this is general advice only, and you should always consult a professional advisor before making any investment decisions. And if you haven't had the chance to go back to the foundational episodes, we've got good news for you. Go to thepropertycouch.com.au/TPC20 and check out the free binge guide, which gives you the insights you need from the first 20 episodes, where we unpack the foundational pillars of the insider's guide to property, finance, and money management. It's completely free and available now.